Good afternoon, and welcome back to another Westwood Multi-Asset Monthly video. My name is Ben Chittenden, and I'm a portfolio manager and research analyst here at Westwood. As you've seen in prior months, the goal of these monthly videos is to leave you with three key messages. First, how did the asset classes perform over the past month? Second, what we're focused on coming up over the next few months. And then third, how are we thinking about the environment over the next 12 months? So let's jump right in. Now, this first slide is our high-level market update slide. If we start with the equity section, you can see that there's a very large divergence in the performance of certain indices over this past month. For instance, take a look at the S&P 500 equal weight index and then compare that to just the normal S&P cap weighted index. The equal weight index outperformed by almost 2%. That's the broadening out of performance that we've been talking about and how we're positioned for. Or take a look at the Russell value versus Russell growth performance. This one's even more striking. Here we see the performance divergence is 6%. And this is just in the month of January. So the message that the equity markets are trying to tell us is that the broadening out of performance is real, and it's more tied into the value side. Now, on the fixed income side, we can see that credit, and again, this is more investment grade corporates and high yield corporates, outperformed treasuries on a total return basis. And this is really just because credit spreads continued to tighten while rates stayed largely flat over the course of the month. Now, if we look at the next slide, we can see a breakdown of the sectors of the equity market. Here we see things like energy, industrials, and materials all significantly outperformed in January. These are the cyclical sectors of the economy, so it's very consistent with what we saw in the index level. Now on slide 5, here we can see that industrial bonds outperformed. And this is another indication across a different asset class that cyclicality is outperforming. Now, another thing we can look at is credit ratings. And so what we show here is that as you go out the risk spectrum and think about this as AAA corporate bonds are your highest quality, least risky, all the way down to double Bs, which again, this is just the lowest we show on this page. But the performance got better and better the lower you went in credit quality, so the further out you got on the risk curve. So now we've seen across sectors in both credit and equity that the areas that should benefit from an economy reaccelerating all outperformed. So it's a consistent message and another indication across asset classes that cyclicality is returning and value should outperform. Now that's just a quick snapshot of what happened. Now let's move on to what we expect to happen going forward. Now on this next slide, this is our February capital markets outlook. We're still relatively positive. We expect more economic growth than consensus. We expect less inflation risk. So for the next 12 months, we view the backdrop as being more positive for stocks. Now, with that said, we do expect more volatility. We don't expect this to go up in a straight line. While the ingredients are all there for the markets to move higher, we think a lot of that is already being priced in. And so we wouldn't be surprised to see periods of sell-off as the narrative of the back-end loaded growth gets tested. So bringing it all together, what are the three key takeaways for this month? First, markets are already in the process of broadening, and that accelerated in January. Second, we wouldn't be surprised to see more volatility over the next few months as the pro-growth narrative could see some hiccups near term. And third, we do expect pro-growth tailwinds to kick in over the next 12 months, and thus we are still positive on equities and selective in credit. Now, the last thing I want to share with you, this is slide 8, and this is our chart of the month. This is one of the things that we've been thinking through. Since we believe that we're closer to the end of rate cuts, now keep in mind, we expect 2 more, but we're closer to the end than the beginning. The question becomes, what happens to different asset classes from here? That's what we've attempted to answer in this chart. In equity markets, the two things that jump out are that small caps and emerging markets tend to do well in the later innings and after rate cuts have ended. That's a historical analysis, but we think that this will materialize this time as well. Now, that's all I have for you this month. We're happy to share these slides with you or add you to our monthly CMO. If you're interested, just reach out. With that, have a great month, and we'll talk to you soon.